Let's bring in Kristen Bitterly. She's the head of investments in North America at Citi Global Wealth. Kristen, great to have you with us. What's your take on this massive rally that we've seen over the past 2 days?
So I agree with a lot of the comments that have been made. I think our overarching thesis right here is don't fight the Fed. And so nothing has materially changed in terms of their overall trajectory. The past couple of weeks have been very bearish. We've seen some oversold conditions. These types of tactical bounces are very indicative of what you see in bear markets. And in fact, 8 out of the past 10 bear markets, we've seen bounces off the lows of 10%, and not just one, but several. And so this is very common in this type of environment. But I think until we see any type of change in terms of the Fed's trajectory, they're very resolute. Their North Star is inflation, a target of 2%. And we don't expect any type of significant deteriorating employment conditions in the short term. So as long as employment's in check and inflation is nowhere close to that 2%, they're going to continue on this path.
We were just showing what your sort of base case scenario was, and that unemployment would be 5%, earnings growth would contract by about 10%. What are valuations in that sort of world? What is the S&P 500 in that sort of world?
Yeah, and so I think this is the biggest thing that we have to think about, kind of this difference between recessionary bear markets and non-recessionary bear markets. Our base case is actually we increased our probability of seeing a recession in 2023 up to about 70%. So that's become our base case because a lot of the tightening that the Fed is doing, both in terms of rate hikes as well as quantitative tightening, it will not flow through into the economy or into earnings for at least 6 and sometimes upwards of 12 months. And so, yes, we're calling for an earnings contraction next year of about 10%. And additional downside to the S&P 500, we expect a lot of volatility from here. You could see some additional downside of upwards of about 10%.
Hey, Kristen, it's Tim. So with that backdrop, though, allocating for clients over the long term, this is what you do. And how about this being an environment where if I have a checklist of things that need to happen, one of them is valuations need to trough. And I'm not saying valuations have troughed, but we're 15 times forward on the S&P, depending on where you're bringing in that earnings estimate. That's not bad. And it's a long way off of where we were. At what point do you start nibbling here? Because there are great companies that are for sale right now.
Absolutely. And this is one of the things, if you are someone who has a medium-term outlook or even a long-term outlook, being able to buy into this market, of course, creates opportunities. So the situations where we've seen throughout history that the S&P 500 has declined by 25% or more, when you look at the 1-year forward returns, if you look at the 3-year forward returns, over a 3-year period, there isn't a negative observation. And in fact, on average, you see returns in excess of 40%. And if you extrapolate that out to 5 years, you're seeing returns close to 85 to 90%. So as an entry point, I agree, there are a lot of good opportunities. And where we're positioned right now, and one thing I should clarify, we're not sitting this out on the sidelines in cash. We are positioned on the equity side as well as the fixed income side in quality. And so we're benefiting from days like this in terms of the bounce. But we want to lean into those companies that have strong balance sheet and can weather the next 3 to 6 months.
Kristen, thanks. Kristen Bitterly of Citi Global Wealth. Guy, what do you think a world looks like with unemployment of 5%, earnings growth contracts 10%? What are valuations like in your view?
I think it's a market where valuations get to levels we saw. Obviously, I'm not saying financial crisis, but listen, S&P multiples have traded down to the low teens. I think it's reasonable to see an S&P multiple trade bottom out around 15 or so. And again, depending on what earnings you're looking at, 210, 220, you can do the math. It's an S&P that's lower than here. So whether the Fed comes to our rescue or not, the backdrop suggests that things are slowing and you shouldn't pay as much for earnings, which to me means the market goes down.